Most people believe a market crash is simply the moment you lose money. That's not true. A market crash is the moment most people decide to lose money, often permanently. Because what actually destroys long-term wealth isn't the plunging red numbers on the screen. It's the panic-driven decisions made in the middle of the chaos while staring helplessly at those numbers. They sell everything in fear. They lock in massive losses. They interrupt the one silent, powerful force that was quietly compounding their future, often for years. And they rarely realize what's happening in their own mind. Their brain has quietly switched into full survival mode. The same ancient biological system that once protected your ancestors from lions, snakes, and sudden dangers is now desperately trying to protect you from a dropping portfolio. A number, a percentage, a frightening headline. While the panic crowd is reacting out of raw fear, someone else, calm, prepared, and operating on autopilot, is quietly executing a plan. Not because they are smarter or luckier, not because they can predict the future, but because they built a robust system long before the first signs of trouble ever appeared. In this episode, you're going to discover exactly how that difference plays out. Not vague motivational advice, not generic opinions. A clear, repeatable, battle-tested system we call the crash code. Once you truly understand how compounding behaves during extreme chaos, and how your own brain can betray you in those critical moments, you will never look at a blood-red market the same way again. Before we dive deeper, drop a comment below and tell us where you're watching from today. And if you're new here, hit that subscribe button and turn on notifications so you never miss these deep behavioral investigations into money, psychology, and human decision-making. Let's meet Marcus. He is 32 years old and lives in Dallas, Texas. He works in tech sales and earns a solid six-figure income. For the past 4 years, Marcus did everything the mainstream financial advice told him to do. He set up automatic contributions. He invested consistently into low-cost index funds. He avoided speculative day trading and focused on the long term. By early 2022, his portfolio had steadily grown to $85,000. For the first time in his adult life, it felt real and tangible. He began imagining what that money could become in 10 or 15 years, a comfortable down payment on a house in a good neighborhood, the freedom to travel more, or even the possibility of retiring earlier than his parents ever could. Then, on one ordinary Tuesday morning, while sipping his coffee, Marcus casually opened his brokerage app. Everything was red. Not slightly red. Violently, sickeningly red. The S&P 500 was down over 5% before lunch. By the end of that week, it had dropped 12%. Within 3 painful weeks, some of his holdings were down 18%, then 25%. Headlines screamed from every screen and notification. Markets in freefall. Recession fears intensify. Worst week since 2008. Marcus told himself to stay calm. Logically, he knew markets go through corrections and bear markets. He had read the classic investing books. He had watched countless educational videos. But knowledge in calm times and raw emotion in crisis are two entirely different realities. As the losses deepened day after day, something profound shifted inside Marcus. The numbers stopped feeling like abstract percentages. They began to feel like a direct threat to his future security, his self-image as a responsible investor, and the dreams he had started to build. At first, Marcus tried to look away. He forced himself to check the app less often. But the anxiety only grew stronger. He found himself compulsively refreshing the screen multiple times a day, desperately hoping for any sign of green. Each refresh brought worse news. His brain, wired over millions of years for survival, kicked into overdrive. It delivered one urgent, primal message. Get out now. Stop the bleeding. You can always buy back in later when things calm down and feel safer. This wasn't a character flaw or weakness. This was pure human biology at work. Your brain does not distinguish between a 25% portfolio drop and a physical predator in the grass. To the amygdala, Both feel like immediate danger. The faster you act to remove the threat, the safer you feel in the moment. So one stressful evening, after staring at the declining numbers for nearly an hour, Marcus finally made the decision. He sold everything. In that single click, the bleeding stopped instantly. The constant knot of anxiety in his stomach vanished. A powerful wave of relief washed over him. For the first time in weeks, he slept deeply through the night. What Marcus didn't realize in that moment of calm was that this short-term relief had come at an enormous hidden cost, one that would silently cost him years of potential wealth. Here's what almost every financial influencer and guru gets dangerously wrong. They focus on telling you what to do during a crash. They rarely explain how your brain actually behaves when the pressure is real and the stakes feel personal. Compounding is one of the most powerful forces in the financial universe. But it is also incredibly fragile, not because the mathematics breaks down, but because human beings emotionally interrupt it at the worst possible moments. Let's make the math painfully clear with a simple but realistic example. You invest $10,000. It grows 10%, then another 10%. Now you have $12,100. Then the market crashes and your investment drops 40%. You're no longer looking at $12,100. You're now sitting at just $7,260. To simply get back to your original $10,000, you don't need a 40% gain. You need a 67% gain just to break even. That's the brutal, unforgiving asymmetry of losses. But numbers alone don't capture the full human story. Losing money doesn't feel like math. It feels like physical pain. It feels like fear for your future. It feels like deep regret and self-doubt. And your brain is hardwired to eliminate that pain as quickly as possible, even when the solution severely damages your long-term financial future. This is exactly why so many otherwise intelligent people sell at or near the bottom, only to watch helplessly from the sidelines as the market eventually recovers without them. What makes this pattern even more dangerous is the cruel timing of the market. The single best days, the biggest, most explosive rebound days, almost always occur during the worst periods of fear, panic, and maximum volatility. These sharp, violent recovery days do not send advance warnings. They arrive suddenly while most investors are still paralyzed in cash, waiting for the all-clear signal that never quite comes. If you are not invested when those days hit, you miss them entirely. Historical studies consistently show that missing just the 10 best days over a 20-year period can cut your overall returns by more than half, sometimes even more. When Marcus sold in panic, he didn't just stop losing money on paper. He disconnected himself from the powerful recovery engine that would have eventually carried his portfolio forward. He stepped out of the game right before the most profitable and opportunistic phase began. Now let's meet Daniel. He is the same age as Marcus, has a similar income, started with roughly the same portfolio size, and experienced the exact same terrifying crash. The red numbers hit him with equal force. The fear and uncertainty felt identical in the beginning. But Daniel had quietly built something that Marcus never had. Not more knowledge, not better market predictions, not superior intelligence or willpower. Daniel had built a system, carefully designed and put in place long before any crash began. So when the market turned blood red, Daniel didn't panic or freeze. He simply executed the system he had already designed and automated. This is what we call the crash code here at WealthWild. It is not a motivational list of steps that require heroic willpower when emotions are running high. Instead, it is a series of automated systems and pre-decided protocols that continue running with minimal emotional input, even during the worst market storms. Here are the 3 core components that consistently separate those who lose years of progress from those who quietly gain them. 1. Protect the foundation, the emergency buffer. Daniel maintained a separate cash reserve that covered 6 full months of living expenses. This money sat safely in a high-yield savings account, completely untouched and ring-fenced away from his investment accounts. This buffer wasn't just extra cash. It served as powerful psychological armor. Most people don't sell stocks during crashes purely because they want to. They sell because they have to, when a sudden job loss, medical emergency, or major repair forces their hand at the absolute worst possible time. Daniel never faced that forced choice. His buffer absorbed life's unexpected shocks, giving his long-term investments the freedom to stay invested even when the world felt like it was collapsing. 2. Automate the system. Remove emotion completely. Every single month, without exception, Daniel had automatic transfers set up that invested a fixed dollar amount into his diversified portfolio, no matter what the market was doing. When the crash hit and asset prices fell sharply, his system didn't pause or hesitate. It actually bought more shares for the same monthly investment. While Marcus was frozen in fear and obsessively checking prices, Daniel's automated system was quietly accumulating quality assets at a significant discount. This is dollar-cost averaging transformed into a true emotion-proof machine. 3. Position before the impact. Intelligent diversification. Daniel never concentrated everything in one bet or sector. His portfolio was thoughtfully diversified across different asset classes, industries, and even geographies. When technology stocks crashed particularly hard, other areas of his portfolio, such as consumer staples, healthcare companies, or certain defensive bonds, held up better or even provided some stability. This diversification didn't prevent all losses, but it prevented total devastation and kept him well-positioned to participate fully in the eventual broad recovery. 3 months after the worst of the crash, the market slowly began to stabilize. Then the recovery started, first tentatively, then with surprising momentum and speed. The same headlines that had screamed panic and doom just weeks earlier now shifted to celebrate resilience and rebound. Marcus watched everything unfold from the sidelines. He was still waiting for the perfect, risk-free moment to get back in. But that ideal moment never arrived. The lingering fear made every small dip feel dangerous again. Meanwhile, Daniel had never left the market. Not only did he remain fully invested, he had continued buying throughout the decline at much lower prices. He now owned significantly more shares than before the crash. His average cost basis had improved dramatically. When the full recovery finally arrived, Daniel didn't simply break even. He surged meaningfully ahead. The gap between Marcus and Daniel, which had started with nearly identical portfolios, had now widened into several years of compounded wealth and opportunity. Here is the uncomfortable but liberating truth. A market crash is not primarily a loss event. It is a transfer event. Wealth quietly transfers from the emotionally reactive to the systematically prepared. From those who allow fear to drive their decisions, to those who removed critical decision-making from the moment of maximum fear. From panic to protocol. History has shown this pattern repeatedly. During the 2008 financial crisis, the sharp 2020 COVID market crash, and the 2022 bear market. Investors who stayed disciplined and continued their systematic approach emerged far stronger than those who sold in terror and tried to time their return. The consistent winners were not fortune tellers or geniuses. They simply built systems that kept operating even when their emotions were screaming to do the opposite. If there is one powerful idea you carry away from this episode, let it be this. The crash itself is rarely the real problem. Your brain's instinctive reaction to the crash is. The exact same market conditions, happening at the exact same time, can create two dramatically different long-term outcomes. One investor reacts with raw emotion and loses years of hard-earned progress. The other calmly executes a pre-built system and gains years of advantage. The critical difference wasn't decided in the heat of the crash. It was decided months or even years earlier, in the quiet moments when they chose to build reliable systems instead of depending on willpower when fear was at its peak. If this episode shifted the way you see market crashes and investor behavior, let us know in the comments. When the market drops sharply, what is usually your first instinct, and how do you want to change that going forward? If you're ready to build your own crash code step by step and better protect your financial future, make sure to watch the next episode that just appeared on your screen. Remember this: the investors who consistently win during periods of chaos don't simply react to the market. They prepare for it in advance. Thanks for watching. We'll see you in the next WealthWild investigation.